investors flip bullish as soon as you make an all-time high. So in other words, investors generally fight after a decline, they'll fight the rally until you make a new all-time high. So basically what happens? Well, at a new high, they turn around and become bullish. And I think that that's going to happen, that as soon as markets make a new all-time high, they turn bullish. One of the leading indicators for stocks is Bitcoin, and Bitcoin hit an all-time high this week and has continued to power through that. So Bitcoin's prior all-time high was January 2025 at 109,000. And on May 21st, Bitcoin made a closing high above that level and has continued to power higher.
For the second week in a row, markets have felt normal, according to Lee. That means no political drama, no surprise tweets, no trade war headlines, and no central bank shockers, just calm. And in response, markets have settled into a steady rhythm. But there was one headline that made waves. Moody's downgraded the U.S. government's credit rating from AAA to AA1. That makes it the third major agency to do so, following S&P in 2011 and Fitch in 2023. Still, Lee believes this move doesn't hold much real weight. He calls it more noise than signal. We're breaking it all down in this video, why the downgrade happened, why Lee thinks it doesn't matter much, and what it could mean moving forward. So stay tuned until the end to get the full picture and insights that could impact your next financial decision. If you're getting value from these videos, make sure to hit that like button, subscribe, and turn on the notification bell so you never miss an update. And we want to hear from you. Drop your thoughts in the comments below. Every like, share, and comment helps more than you know and fuels the growth of this channel. Thanks for watching, and let's dive in.
Over the past week, granny shots gained 6.36%. The S&P gained 5.33%, which means the granny shots outperformed by 102 basis points. Year to date, granny shots is outperforming the S&P 500 by 323 basis points, of which since April, granny shots is outperformed by 843 basis points. I want to give you some thoughts on the market. I think that this is the second week that I feel like things have returned to normal, or the second consecutive week that the stock market has felt normal. And what I mean by that is we haven't had disruptive events. For instance, there haven't been any tariff provocations, no controversial Truth Social posts, no Fed versus White House spats, no CEOs getting lambasted. However, we did get a Moody's downgrade of the U.S. government from AAA to AA1. Now, this ratings action took place on Friday, May 16th, so just about a week ago, but we don't believe there's much signal here. One of the reasons is that Moody's is the last to downgrade the U.S. from AAA. The first one was the S&P Standard & Poor's in 2011. That was a lot of signal. The second one was Fitch when they did this in August 2023. And of course, now we have Moody's. So they're really the third ones. I mean, in some ways, let's be realistic. The stock market and the bond market would have already figured this out. Like I said, the bond market anticipated the ratings change. And the U.S. essentially lost its AAA status because of the way split ratings work in 2023. And realistically, the corporate cost of debt is largely unchanged. I mean, even high yield has barely moved. Corporate earnings visibility is largely unchanged. Demand by consumers isn't really going to be affected by this downgrade. And I think bears want the stock market to fall, but to me, this is purely just incremental, and I don't think there's much signal. And that gets us to this point, which is, in many ways, this remains one of the most hated stock market rallies. You know, it seems like investors are looking for reasons for stocks to fall rather than for stocks to rise. And part of this is understandable. We had a black swan event in post-tariff liberation day, and a black swan event meaning an unexpected event, and we had a 20% fall in stocks in a very short period of time. But most hated rallies are not something new. After the COVID low, that was a most hated rally. When stocks began to rally after March 2020, many fund managers said we're still in a bear market. And recall, in the fall of 2022, after the markets made its low in October 2022, a lot of investors were saying that this was just another bear market rally. Investors are about to make a mistake again. So again, a most hated rally. And of course, we have the same chorus of skeptics saying stocks have had a good bounce, but we think we're going to retest the lows. But here's the reality. Investors flip bullish as soon as you make an all-time high. So in other words, investors generally fight after a decline, they'll fight the rally until you make a new all-time high. So basically what happens? Well, at a new high, they turn around and become bullish. And I think that that's going to happen, that as soon as markets make a new all-time high, they turn bullish. And here's where things stand today. We're more than 17% above the lows and only 3% away from the highs. So it won't take a lot for investors to turn bullish if we can reattain that 61.47. So is there firepower to drive this? Yes. For instance, in the latest Bank of America Fund Manager Survey, the US stock market is the most consensus underweight. In other words, most fund managers agree to underweight the US. Well, that's a contrarian signal to me because when they're all underweight US, that means that you've priced in a lot of bad news. Similarly, hedge funds have increased their short futures exposure on stocks at the fastest pace in more than a decade. Again, to me, that's a contrarian bullish signal because you've already seen people position for stocks to fall. And I think at a minimum, this keeps pullbacks shallow in the stock market. One of the leading indicators for stocks is Bitcoin, and Bitcoin hit an all-time high this week and it's continued to power through that. So Bitcoin's prior all-time high was January 2025 at 109,000. And on May 21st, Bitcoin made a closing high above that level and has continued to power higher. I think that's a leading indicator for the S&P because Bitcoin peaked about a month before the S&P did. And they're both being driven by the same thing, that global liquidity is increasing. And this tweet by Raoul Pal really highlights the relationship between Bitcoin and M2. As for granny shots, now when we break it down by themes, again, there's 7 themes in the granny shots. Seasonality is the best performing relative to the S&P, outperforming by 320 basis points. Again, this is led by Palantir. The second is global labor suppliers, and that's led by stocks like Tesla, Nvidia, AMD. And the third is energy and cybersecurity, and that's led by names like ANET, Palantir, GE Vernova, CrowdStrike, and Palo Alto Networks. Finally, before I sort of close this video, just want to remind you that really, if you look back at the last 2 weeks, but really since April, one of the lessons we've learned is it really paid off to actually not do too much, take too many dramatic actions. I know it's really hard instinct to fight, but it's a reminder of the rule of 10 best days, that if you miss the 10 best days in the stock market, you really have dramatically lower returns. And I've talked about this before, but to give you an example, since 2015, the S&P's returned 12% a year. But if you miss the 10 best days, you've actually had negative 10% performance or 2,200 basis points of underperformance. So please remember to not time the market.
Lee wraps up with a powerful reminder: don't try to time the market. He points to a crucial piece of investing wisdom, the 10 best days rule. Since 2015, if you simply stayed fully invested in the S&P 500, you'd have seen an impressive 12% annual return. But if you miss just the 10 best days during that period, your return drops to minus 10%. That's a mind-blowing 2,000 to 100 basis point difference just for trying to outguess the market. Why does this happen? Because volatility and big gains often come hand in hand. Clustering around major turning points, step out at the wrong time, and you risk missing the upside. The bottom line? Jumping in and out of markets is usually a losing game. Let's listen to what Lawrence Lepard has to say about this.
The government, the banks, and the Federal Reserve are all in cahoots. And they've got a system that works really great for them. If you get elected in the government, you can generate a huge net worth on a small salary. If you're a banker, you can become very, very wealthy in a heads they win, tails we all lose scenario, because if they do things that are too risky and it blows up, we print the money to bail them out. They paid $20 billion of bonuses the year after the 2008 bailout. Even if you're a hedge fund, we bail you out. I mean, Ken Griffin got a bailout in March of 2020 when the COVID thing hit, because his basis trade went upside down. And so you get to this thing where these big organizations are able to kind of, count on free money in situations where, they get themselves in trouble. So that's kind of the story. And it's somewhat of it's a problem. It's the core of the underlying problem. Basically, the system's broken, but the system is, nature's healing, and things will get fixed over time. And that's why I'm quite optimistic, and that's why I'm so excited for Bitcoin. I think that's why all Bitcoiners are excited. Once you come to see it and understand it, you can't help but be excited that that things are going to get better. And again, that's really the purpose behind the book. I'll just lift it up here and show people. Just it's on Amazon. It's called The Big Print, and it really, I tried to write it. I don't know, who's read it and what not, but I tried to write it at a level that, you don't need to know what monetary economics are. You don't need to be into this stuff. You just need to kind of read it and hear the story. And I think what you'll realize is that, oh, yeah, this really is wrong. And they've it's not American. It's not fair what they're doing and they've done. And, there are a lot more of us than there are people in the banks and the Federal Reserve, and we have a vote on what happens here. So, they've done it in a sophisticated way, and they put it in great language that make them sound like they're working on behalf of the American people. I mean, Jay Powell repeats that all the time. I'm doing what's the best, but they're not. and the book provides compelling evidence of how they are not. And so once you see that, you can't unsee it. And then I think what you do is you get mad and or you start thinking, okay, well, given that's the case, there's a problem here. What's the solution? And the second half of the book is the solution. I mean, Bitcoin really is the solution.
Lawrence Lepard closes with a deeper, more philosophical critique, one that strikes a chord with the Bitcoin and sound money communities. He argues that the current financial system isn't just flawed, it's fundamentally broken. In his view, government officials somehow amass massive personal wealth while earning modest public salaries. Bankers thrive in a rigged system, they rake in huge profits during booms, and get bailed out with taxpayer money when their risky bets go bad. Even hedge funds like Ken Griffin's Citadel received bailouts during the COVID crash of 2020 despite their enormous private wealth. It's a system of privatized gains and socialized losses, and for many, that's exactly why alternatives like Bitcoin matter. If this perspective resonates with you, or even if it challenges you, make sure to like this video, subscribe to the channel, and turn on notifications so you never miss critical insights like this. And if you want to dive deeper, be sure to watch more videos from our channel. We cover everything from macro trends to crypto analysis and the future of digital assets. Thanks for watching. See you on next video.